In the ever-evolving landscape of financial markets, investors constantly seek strategies to optimize their portfolios. Modern portfolio theory, MPT, emerges as a guiding light, offering a framework for constructing portfolios that maximize expected returns while minimizing risk. This article delves into the application of MPT principles, specifically focusing on the integration of the FDIG ETF, an innovative fund designed to track the performance of the Fidelity Digital Assets Index. MPT, a cornerstone of investment strategy. Developed by Harry Markowitz in the 1950s, MPT revolutionized investment thinking by shifting the focus from individual asset performance to the holistic risk-return relationship within a portfolio. Its core principles are: diversification. By combining assets with low correlation, investors can mitigate the impact of market fluctuations on their overall returns. Efficient frontier. This curve depicts the optimal combinations of risk and return achievable through diversification. Portfolios on the frontier offer the highest expected return for a given level of risk or the lowest risk for a given expected return. Capital Asset Pricing Model. CAPM. This model helps estimate the expected return of an asset based on its beta, a measure of its volatility relative to the market. MPT provides a powerful framework for building resilient portfolios, especially in today's dynamic market environment. However, its practical application requires careful consideration of individual risk tolerance, investment goals, and the availability of suitable assets. FDIG ETF, a gateway to the digital age. Enter the FDIG ETF, launched in 2021 by Fidelity Investments. This passively managed fund tracks the Fidelity Digital Assets Index, offering investors exposure to a diversified basket of leading cryptocurrency and blockchain companies. The index includes established players like Coinbase and MicroStrategy alongside emerging innovators in various blockchain applications. FDIG presents several intriguing advantages for MPT-based portfolio construction. 1. Diversification. Cryptocurrencies exhibit low correlation with traditional asset classes like stocks and bonds, thereby enhancing portfolio diversification and potentially reducing overall risk. 2. Growth potential. The blockchain industry holds immense potential for growth, fueled by its disruptive potential in various sectors. FDIG offers exposure to this burgeoning market, potentially boosting long-term portfolio returns. 3. Liquidity. Despite the inherent volatility of cryptocurrencies, FDIG provides access to a liquid market through its ETF structure, facilitating easier entry and exit for investors. Integrating FDIG into MPT portfolios. While FDIG holds promise for MPT-based portfolios, its integration requires careful consideration. 1. Risk management. Cryptocurrencies remain highly volatile compared to traditional assets. Investors must align their FDIG allocation with their risk tolerance and overall portfolio risk profile. 2. Strategic weighting. MPT principles suggest allocating assets based on their expected returns and risk contributions. Determining the optimal FDIG weight within a portfolio requires careful analysis and ongoing monitoring. 3. Market analysis. The fast-paced nature of the crypto market necessitates continuous monitoring of industry trends, regulatory developments, and individual company performance to ensure informed investment decisions. Case studies, applying MPT with FDIG. To illustrate the potential of FDIG in MPT portfolios, consider 2 scenarios. Scenario 1, risk-averse investor. An investor with a conservative risk tolerance might allocate 5% of their portfolio to FDIG. This allocation leverages the diversification benefits of cryptocurrencies while limiting potential downside risk. The remaining 95% could be invested in a diversified portfolio of traditional assets like stocks and bonds, providing stability and income. Scenario 2, Growth-Oriented Investor. An investor with a higher risk tolerance seeking long-term growth could allocate 10% to FDIG. This allocation captures the potential upside of the digital asset market while maintaining a balanced portfolio. The remaining 90% could be invested in a mix of growth stocks and income-generating assets, ensuring diversification and potential for capital appreciation. These scenarios are illustrative and do not constitute financial advice. Investors should conduct their own research and consult with financial professionals before making any investment decisions. Beyond FDIG, expanding the cryptocurrency frontier. While FDIG offers a compelling entry point for investors seeking exposure to the digital asset market, the landscape is constantly evolving. Emerging trends like decentralized finance, DeFi, and non-fungible tokens, NFTs, present further diversification opportunities. As the regulatory environment around cryptocurrencies matures and infrastructure develops, more innovative investment vehicles are likely to emerge, offering even greater granularity and risk-return profiles. Conclusion: embracing MPT in the digital age. Modern portfolio theory remains a cornerstone of investment strategy, providing a framework for constructing resilient and efficient portfolios. The emergence of FDIG and the broader cryptocurrency market offers exciting possibilities for diversifying portfolios and capturing the potential of the digital age. However, integrating these new assets requires careful consideration of risk, strategic analysis, and ongoing monitoring requires careful consideration of risk, strategic analysis, and ongoing monitoring. While MPT provides a roadmap, navigating the intricacies of the digital asset market necessitates a blend of traditional financial acumen and adaptability. Investors must remain abreast of technological advancements, regulatory developments, and emerging trends within the blockchain ecosystem. Continuous learning and a willingness to adapt are key to harnessing the potential of this dynamic space within an MPT framework. Here are some additional points to consider for the conclusion. 1. Emphasis on long-term perspective. Investing in the cryptocurrency market requires a long-term perspective due to its inherent volatility. While short-term fluctuations can be significant, MPT encourages focusing on the long-term potential for growth and diversification benefits. 2. Importance of education and research. The rapidly evolving nature of the digital asset market necessitates ongoing education and research. Investors should stay informed about industry news, developments in blockchain technology, and regulatory changes to make informed investment decisions. 3. Professional guidance. While MPT provides a valuable framework, consulting with a financial professional knowledgeable about cryptocurrencies and traditional assets can be highly beneficial. They can help tailor an MPT portfolio that aligns with individual risk tolerance, investment goals, and specific preferences for exposure to digital assets. Remember, the financial landscape is constantly evolving, and the integration of novel asset classes like cryptocurrencies into MPT portfolios offers both challenges and exciting opportunities. By embracing a measured and informed approach, investors can leverage the power of MPT to navigate the digital age and construct portfolios that not only maximize return, but also mitigate risk and ensure long-term financial stability and growth.